Hello everyone and welcome to another deep dive session into the international financial markets. We are Must Profit, and today we are going to break down the most critical institutional setups for the month of April 2026. I am your senior Forex research analyst, and today we are entering the second quarter of the year with a very clear roadmap. As we open the Q2 liquidity, the markets are showing some very high probability setups across major instruments. Before we look at the charts, I want to talk about our core philosophy. If you want to survive in this market for 15 years as we have, you must stop thinking like a retail trader. We don't trade head and shoulders or RSIs. We follow smart money. We look for where the big banks and institutions are trapping liquidity. We identify the footprints they leave in the form of order blocks, fair value gaps, and liquidity sweeps. Today, we will analyze gold, WTI crude oil, silver, and the NAS100. We will map out the supply and demand zones and, most importantly, discuss the specific scenarios for today's price action. Let's head over to the charts for our first 4-minute segment. Let's start with the king of commodities, gold. Currently, XAUUSD is trading near the 4,720 mark. Looking at the H1 timeframe, the primary market structure remains strictly bearish. We have been observing a series of lower highs and lower lows since last week. However, notice the recent rally. Many retail traders are calling this a trend reversal because the price moved up from the 4,500 lows. But if you apply our AHI logic, this is nothing more than a bullish retracement. The price is simply pulling back into a premium supply zone to gather sell-side liquidity before the next major drop. We have a very high probability supply block, sitting between 4,720 and 4,750. This area is the origin of the last major bearish displacement. As of right now, the price is reacting within this zone. On the downside, we have a weak demand at 4,500. I call it weak because there is massive sell-side liquidity sitting right below it. Our primary institutional targets are much lower, at the 4,300 to 4,350 zone. In scenario A, we wait for a change of character, CHOCH, on the M5 or M15 timeframe inside the 4,720 to 4,750 zone. If we see a sharp rejection, our intermediate levels to observe will be 4,600 and then 4,500. In scenario B, which is the trap, be careful of a liquidity sweep above 4,750. Institutions often push the price slightly above a known resistance to trigger buy stops before crashing the market. Do not FOMO buy on a breakout. If the price achieves a daily close above 4,765, our bearish thesis for today is invalidated. It is vital to understand that the institutional footprint is not just about a single candle or a single line on the chart. It is about the intent behind the move. When we see a massive displacement like we saw in gold earlier this week, that leaves behind what we call fair value gaps. These gaps act like magnets. The market often returns to these gaps to balance the price before continuing in the original direction. This is exactly what we are seeing today. The price of gold returning to the 4,720 level is a balancing act. It is providing the liquidity necessary for big players to re-enter their sell positions. This is the essence of SMC, understanding that price moves to where the orders are. As we look at the volume profile, we can see that institutional participation is increasing as we approach the supply zone. This confirms our bearish bias. Stay patient and wait for the confirmation. Now, moving to our second 4-minute segment, WTI crude oil. The energy market is currently very volatile. WTI is trading around 100.25. The H1 chart shows a clear downward continuation. Even though we've seen some green candles recently, the overall momentum is fading as we approach higher levels. We are in a premium zone. When the market is in a premium zone, we don't look for buys, we look for signs of distribution. The upside momentum is visibly slowing down, forming a classic Wyckoff-style distribution pattern. The major barrier for WTI is the 105.00 to 108.00 zone. This area has historically shown strong institutional selling pressure. Unless we break this, the sellers remain in total control. If the downward reaction starts, our first level of interest is the 90.00 to 92.00 area. Below that, we have a massive accumulation base at 82.00 to 84.00. In scenario 1, if the 105.00 resistance holds, we expect a rotation lower. The immediate levels to observe are 96.00 and 92.00. In scenario 2, a temporary spike toward 108.00 is possible to collect liquidity. This is often a trap. We will only look for sell confirmations once the price enters this supply zone and shows exhaustion. The distribution we see in the 105.00 to 108.00 range suggests that the smart money is already offloading their long positions. They are preparing for a move lower, and they are using the current price strength as an exit strategy. Trading is a game of psychology, as much as it is a game of numbers. By following the institutional flow, you are putting yourself on the side of the people who actually move the markets. When you sit down at your trading desk, ask yourself, who is trapped right now? If you see a breakout that looks too good to be true, it probably is. That is the liquidity sweep. If you see a support level that has been tested 5 or 6 times, it is likely about to break because the liquidity below it has been building up. We at Must Profit always emphasize that oil is not just about the news, it is about the structural imbalances. The imbalances are clearly pointing toward the downside once the premium liquidity is grabbed. Our third 4-minute segment focuses on silver. XAGUSD is currently trading near 75.13. Silver's structure is almost a carbon copy of gold, but with significantly higher volatility. We are seeing a classic lower high formation. After a massive drop last month, silver is currently in a corrective phase. The recent upward move is not a reversal. It is a pullback into a heavy resistance area. The bias remains firmly cautious. The 80.00 to 82.00 zone is our line in the sand. This is where the last structure shift occurred. The price is currently trying to build momentum to test this zone, but notice how the candles are getting smaller. This is a sign of weak bulls. For demand, 78.00 is the immediate support. 75.00 is where the broader liquidity is sitting, and 6,800 to 7,100 is our long-term institutional interest area. In scenario 1, we see a continuation of the bearish trend. If silver fails to break 82.00, it will likely rotate back towards 75.00 and 71.00. In scenario 2, a temporary push into the 80.00 to 82.00 zone traps retail buyers before the next leg down. Silver's high volatility means you must be very careful with your lot sizes. Always wait for a clear M15 break of structure before making any decisions. The volatility is your enemy if you are not prepared, but it is your friend if you know where the targets are. The 75.00 level is a major psychological and structural level. If the bears can push past this, we could see a very fast move toward the 71.00 area. Remember to keep your charts clean. Too many indicators can cloud your judgment. Focus on the price, focus on the volume, and focus on the zones. Everything else is just noise. The AHI logic we use at Must Profit is designed to filter out that noise and give you a clear map of the battlefield. We are not here to predict the future. We are here to react to the high probability setups as they occur. Look at the correlation between silver and the dollar index. If the DXY shows strength, silver will inevitably follow its bearish path. This is multi-time frame analysis at its best. Finally, our last 4-minute segment, the NAS100. The tech-heavy index is trading at approximately 23,869. While the broader market has been in a long-term downtrend, we have seen a very strong corrective rally from the 22,800 demand base. We are now approaching a major wall. The 24,300 to 24,500 zone is a massive institutional supply area. In our previous research, we identified this as a distribution point. The price is slowing down near the 23,900 to 24,000 mark. There is no confirmed breakout yet. This suggests the market is pausing to decide its next directional bias. For upside, a sustained move above 24,500 would change our bias to bullish, opening the path toward 25,000. For downside, if the resistance holds, look for a rotation toward 23,600 and eventually a retest of the 22,900 support. The tech sector is at a crossroads. Interest rate discussions and economic data often drive this index, but the chart tells us that 24,300 is the ceiling for now. Until the index can prove it has the strength to break that ceiling, we must treat every rally as an opportunity for the bears to re-enter. As we conclude this session, take a moment to review your trade plan. Do you have your entry criteria ready? Do you know exactly where you will exit if the scenario changes? Discipline is the difference between a gambler and a professional analyst. Stick to your rules, respect the market, and let the institutional flow guide your decisions. We at Must Profit will be monitoring these levels throughout the day and will post updates as the price action develops. Stay sharp, stay focused, and let's make this second quarter a successful one. Across gold, oil, silver, and the NAS100, the common theme is a pullback into a premium supply zone. Institutions love these areas because they can fill their large sell orders using the buy stops of retail traders. Patience is your greatest asset today. Do not rush into the market just because the price is at a level. Wait for the reaction, wait for the confirmation, and then follow the smart money. As always, these analyses are based on mathematical probabilities and institutional logic. Ensure you are following proper risk-to-reward ratios and never risk more than 1 to 2% of your capital on a single scenario. Thank you for your time today. This is Must Profit, and we will see you in the next update. Let's capture the moves that matter together. Use these zones to your advantage and always respect the institutional footprints. Happy trading!